Why do gold prices rise? Introduction. The role of gold in the economy. Gold has historically been more than just a decorative metal or a symbol of wealth. It has served as one of the most trusted assets in the global financial system. Even today, central banks hold large amounts of gold in their reserves, and investors see it as a safe haven during times of crisis. But what exactly drives the price of gold upward? In this video, we'll explore the key economic, political, and financial factors behind rising gold prices from an academic perspective. Downward Trend 1. Inflation and money supply. One of the most fundamental factors affecting gold prices is inflation. When inflation rises, the purchasing power of money decreases, and investors start seeking real assets. Historically, gold has maintained its value against inflation, which increases demand. For example, during the high inflation period of the 1970s in the United States, gold prices surged dramatically. Similarly, today's expansionary monetary policies, where central banks inject more money into the economy, raise long-term inflation expectations and boost demand for gold. This creates a clear chain reaction. Higher money supply, right-pointing arrow; higher inflation expectations, right-pointing arrow; increased gold demand, right-pointing arrow; rising prices. Dollar Note 2. Interest rates and opportunity cost. Gold does not generate interest or dividends. Therefore, when interest rates fall, alternative assets such as bonds or savings accounts become less attractive. In a low-rate environment, investors are more likely to turn to gold and other non-yielding assets. For instance, when the U.S. Federal Reserve cuts interest rates, gold prices often trend upward. This is explained by the opportunity cost theory. As interest rates fall, the cost of holding gold decreases, leading to higher demand. Downward Trend 3. The U.S. dollar and exchange rates. Since gold is priced in U.S. dollars globally, it often moves inversely to the dollar's value. When the dollar weakens, gold becomes cheaper for investors holding other currencies, which increases demand. A weaker dollar can also shift global trade dynamics, boosting gold demand in emerging markets. As a result, the dollar index, DXY, and gold prices are closely monitored for their strong inverse correlation. Globe 4. Geopolitical risks and uncertainty. Geopolitical and political uncertainties are another critical factor that drives gold prices up. Events like wars, trade conflicts, financial crises, or political instability push investors away from risky assets and toward safe havens like gold. For example, when the Russia-Ukraine war broke out in 2022, gold prices quickly approached $2,000 per ounce. Similarly, during the global pandemic, rising risk perception accelerated the shift toward gold. Bank 5. Central banks and reserve policies. Central banks also play a key role in gold price movements. Many emerging market central banks diversify their reserves by reducing their U.S. dollar holdings and increasing their gold purchases. Such purchases not only increase demand but also provide long-term price support. For example, large-scale gold acquisitions by the central banks of China and Russia since 2010 have significantly influenced gold's upward trend. Upward Trend 6. Financial markets and speculative capital flows. Another important factor is speculative investment activity. Large institutional investors and hedge funds can drive short-term price movements through futures and derivatives markets. This is known in academic literature as the financialization effect. Today, gold is not just a physical asset but also a major financial instrument. Products like ETFs, exchange-traded funds, make gold more accessible and contribute to faster price fluctuations. Bar graph conclusion. A multidimensional price mechanism. The factors that push gold prices higher are interconnected: inflation, interest rates, exchange rates, geopolitical risks, central bank policies, and financial speculation all play a part. From an academic perspective, gold prices act as a kind of thermometer for the global economy. They rise during uncertainty and remain stable during periods of confidence. For investors, gold is not only an asset but also a key indicator of broader economic trends. Understanding monetary policy, global risk sentiment, and capital flows is essential to understanding gold's movements. Bullseye final thoughts. In conclusion, rising gold prices are not just about investment choices, they reflect deeper global economic dynamics. Understanding the gold market is, in many ways, understanding the economy itself.